London Center for Blockchain Technologies and chair the Nexus Global Lab on Blockchain and Systems Change.
Hey everybody, and thank you so much. I'm so glad to be here. I came all the way from the United States, and so I want to make sure everybody's paying attention. Will you please just stand up for 1 second and join me? Yeah, just refocus here. I have the attention span of an 8-year-old, so I just want to focus everybody. But everybody just take a deep breath in and out. From Denver, Colorado, it's a mile high, so there's more air here. Good job. And now repeat after me: Bitcoin, Ethereum, derivatives. All right, that's not that good, but it's okay. Everyone, please sit. So glad to be here again. Dubai is wonderful. Thank you, Hadi, for having us here. It's really an honor. Today, I want to talk about harnessing crypto growth. So I'm the managing director of TwoPrime. We run a fund basically focused on taking some of the risk out of getting exposure to digital assets through intelligent risk management. For us, we think about crypto kind of like an Arabian horse. It's wild and crazy and can be dangerous, and it has a lot of potential and power, but also can kill you if you don't know what you're doing. And especially, it's like a horse that grows 20 times the size every 4 years, so even more dangerous. So to us, it's a question of how do we harness this power of crypto or the crypto industry and make it something that serves us rather than something we serve, following spikes in price and all sort of crazy behavior. So today, I'm just going to talk a bit about TwoPrime and who we are. Some of the other members of the team are here as well, about how we structure our portfolio. We're a hedge fund, just to be clear, that provides exposure to Bitcoin and Ethereum. Talk a little bit about how we model price so that we can have some bearing of how to manage risk, and how we manage lending and derivatives to take action or express that position on our view of the market. And then lastly, tell you about how to get in touch with me. So as an introduction, here with us today, I'm Alexander Blum, the managing director. Hadi gave me a very nice introduction, but just a regular person trying to work and have a good time. Also in the back of the stage, or back of the room, if you want to raise your hand, everybody look back, Mark Fleury. Mark has a PhD in theoretical physics from the École Polytechnique, which I'm probably not saying right, and was also the founder of JBoss, which was one of the first ever commercially successful and open source businesses. Was bought by Red Hat for $350 million in 2006. And when he's not doing physical experiments, he gives us some insight into the crypto markets. Also with us here today is Peter Lyons, who was formerly at the World Economic Forum. You can see him raising his hand in the back, and has worked at the GSMA and lived here in Dubai for many years as well. And then our last team member, Nathan Cox, I worked out with a traditional hedge fund focused on VIX, or highly volatile public equities, and now works as our chief investment officer. He used to manage a family office of a few $100 million as well. And for us, this fund was really created for Mark and myself. I bought Bitcoin for a little bit, I wish more, for $9 in 2012. Sold some of it, kept some of it, and I'm here today. But for us, Mark has sold a company for $350 million. And, if we could turn that into $1 billion, great. And I guess for us, turning it into 1.1 billion isn't that big of a difference. It's not going to change Mark's life. But if we turn his $350 million into 3.5 million, it's going to be not great. And so for me, what basically we try to do this fund is, how do I turn Mark into a billionaire, but that he's well rested and can sleep at night? That's kind of what's been created in this fund. So for us, basically, our position is, and maybe this is preaching to the choir here, but digital assets are here to stay, and it's going to be an increasingly significant part of a portfolio. Whether you like it or not, you need to have some strategy around Bitcoin, Ethereum, and the crypto space, or you're going to be left behind. Things are moving digitally, and you can either take advantage of that. I think we're still in the early adoption part of that phase, or you can wait and suffer as you try to convert your gold into Bitcoin in a couple of years, and it's not worth so much. But for us, the other aspect of it is that you can do this in a way that preserves and protects wealth. You don't have to just roll the dice and gamble and then hope that you got the right pick of the right horse on the right day, but put some parameters around what you're doing using derivatives and lending strategies. So for us, again, I just want to sleep well at night. Sometimes I check the price of Bitcoin at like 4 a.m. this morning, and then I can't sleep. And so to me, I want to be able to sleep well and make money at the same time. So for us, this is the way we think of our portfolio, which is structured as a very stable, reliable pyramid. We strictly buy Bitcoin and Ethereum. We then do lending through that. So I don't know if you're familiar with groups like BlockFi or Celsius, but basically you lend to them, they pay you a low rate, and then they re-lend it out and do some arbitrage to get a better rate. So we just lend to those end funds after we do some due diligence on them and earn about 8% interest. You can think about it as an 8% hedge against volatility as well. And then lastly, we do derivative trading. The derivatives market in crypto is relatively new. We'll talk about it further in the presentation, but if you know what you're doing, you can manage and maintain a lot of the upside while protecting against much of the downside. And for me, this helps me and Mark sleep well at night. Mark gets very grumpy if he doesn't sleep, and so we want to make sure he's in a good place. So I think everybody here is familiar with Bitcoin. I think this analogy to gold is apt, not just because it's a way to think about it, but it actually, when we get into it, is a way to understand how to model the price of Bitcoin. It's not such a shallow surface analogy, but they both are scarce resources, and Bitcoin being more transportable but having a very specific supply dynamic allows you to model price in a way that you can't even do with gold, and we can use to our advantage. Similarly, Ethereum, many people, including ourselves, have likened it to digital oil. It's not, you can't put it in your car, but there are many uses for Ethereum. It's a consumable commodity that DeFi, NFTs, non-fungible tokens, stablecoins, until everybody adopts Casper Labs, everybody's using Ethereum today. And we can put some parameters around the value of, just like how we know the demand of oil is related to its price, we can look at the demand for Ethereum and its use cases as a way to understand and model the price of that network. And so this is just to show that these beautiful, exciting assets are extremely volatile. Everyone today feels like a genius. Bitcoin's at an all-time high, but not everybody felt like a genius when it went from 20,000 to 3,000, an 85% drawdown. And even during the ride up, there's usually 5 to 7, 20 to 30% retracement, which, if you look at it in retrospect, I just needed to hold and do everything. But each time down, you don't know if it's the 85% move or the 20% move. And it's very tempting to want to sell. It gets very emotional. You're hearing all sorts of buzz and FOMO. Also on here, just to show you, the blue line is the price of Bitcoin and Ethereum being the yellow. And so we can also look here at the relationship or correlation in price between the two. The two usually trade somewhere around 92% of correlation, though I think that will decouple as the use cases for Ethereum and Bitcoin transition over time. We also have seen, Ethereum currently right now is at about a 0.5% relationship to the value of Bitcoin. At its peak, it was about 12%. And so it's another way to look at the historic price and model. So modeling price, this is the stock to flow model for Bitcoin, which is stock to flow is a measure of scarce assets. So it's used to measure the price of platinum, gold, real estate, and basically looks at a ratio of how much existing supply there is and how much new supply is being introduced on an annual basis. And if you divide those things, you get some kind of whole number. So I think gold is about 50. Real estate somewhere about 150. And what you find is the more scarce something is, the higher the price of it is. So what we've seen just to kind of interpret this graph for you, what you're looking at here are these cuts in Bitcoin supply that occur every 4 years called the halving, informally the halvening. And what we see is about the first 70,000 mined blocks of the next wave of Bitcoin scarcity, we see a exponential growth in price, usually 10 to 20x. It's not always exactly the same, but somewhere in that realm. So we've seen this happen really 2 times, 2.5 times very significantly, and now this third real wave of Bitcoin halving. We are currently, you're looking at this orange dot, what you see is about around 70,000 blocks after the last halving, which right now we're somewhere around 40,000 blocks since the last halving. You see a peak in price and then a reversion down about 80 to 70% reversion down, and which, like, it feels good to buy Bitcoin at 10,000 and ride it up to 40,000. It doesn't feel good to ride it from 200,000 back down to 40,000. And so what we're trying to do is avoid that. But what's important here also is we can make some pretty accurate predictions around where Bitcoin is going and how much risk there is in the current price of it, both on a standard deviation model and this scarcity model. And especially today with the price of Bitcoin rising even higher, it's sort of eerie how closely this is tracking to accurate predictions. Similarly with Ethereum, I don't want to get too far into it, but Ethereum, if you can value as a network, you may have heard of Metcalfe's law, which is a model of originally valuing internet or telecom networks, saying that the number of nodes and their interconnectivity gives some determination as to the value of it. N times n plus n minus 1 is usually Metcalfe's law. Zipf's law is a further derivation of that looks at the larger nodes or the larger, more active nodes holding more value in a network, but still another way of pricing networks. So you can see here the market price of ETH has tracked somewhat closely to Zipf's law, and again, provides some barrier or some basis at least to start to understand the price and where it is in terms of its relationship to the market or its history. Here also I want to look, what we're looking at here is the past 2 cycles of the Bitcoin supply cut, their peak price and their reversion down. In the light blue color is the 2012 rise, which was about 20x at its peak. And the lower darker blue was the last cycle, which was about 10 to 12x. Currently, the red one is where we're at now, and we're tracking somewhere in between. So we're looking at maybe a 15 to 16x growth from its previous all-time high, which for us puts it around $280,000 at peak Bitcoin, where it will not stay for long. What I can assure you is that the price will go back down until the next cycle. It will stay higher than 20,000, or I would predict it would actually end up somewhere around 40 to 45,000 as it gets back to its trough. And then this cycle starts over. Also, you know, it's very exciting, Bitcoin and Ethereum right now, but most of the years, there's either a drop down or a very linear flat path. And so during those times also with derivatives, we'll get into it further, but you can manage risk and mine premium in order to continue to yield income. So the derivatives market is a very new thing to Bitcoin and Ethereum. The real market started in about the beginning of 2020, and there was 1,800% growth in options volume just in 2020 alone. This speaks both to the growth of the industry and institutional entrants that want to be able to manage risk. We also saw just from December to January of last year, a 50% growth in options volume. For us, this is good news because we can both get greater liquidity in the options market, and it means that there's other people that are here to stay. You see a lively derivatives market when you see a lively asset that isn't a fad or a short-term product. Similarly, the implied volatility of the options market, which I don't want to get too much into it, but it's basically a prediction of how much this thing is going to move and how much an option is worth over time, is unlike anything I've ever seen. I've worked at traditional high volatility public equities hedge funds. To give you an example, at the peak of the 2008 financial crisis, we were looking at options for the VIX of about 80% implied volatility. In Bitcoin, it's regularly between 50% and 250%, which means that options are very expensive, or what's called vega in the options Greek's language. And basically what it means is you can sell options premium for high prices in order to add extra income and also to finance puts or finance protection on a portfolio, so that as we ride the price of Bitcoin and Ethereum upwards, we have protection for the, what is, I'm telling you, the inevitable drop down for some period of time in the price. And for that day, we may be just doing a lot of work up until then, but on that day when the price, or that week when the price goes down 60 or 80% for the next 3 years, what we do feels really good. So in conclusion, what you can do is look at options premium, look at where we're at in the progress of these modeled prices of Bitcoin and Ethereum, and add extra hedge as you go along. For us, that means that we're going to take a little bit less return, but still be able to sleep at night. We've been implementing this strategy since June of last year, initially with about 30 million of founders capital. We have additional about 50 million of outside commitments as of our fund was launched officially on February 1st. and I've been successful to date, and I feel well rested as well. So I'm very happy to speak with anybody. We'll be here until Saturday, and I thank you for taking the time to listen. Thank you.